Good evening to everyone. We are going to start the session. Uh, I think everyone can see the screen and I have shared the paper. You have already attempted this one. Uh, okay, guys, shall we start? I think you are ready to go through what you have done and you might have received the marks and you want to see where it went wrong and how are you going to progress to your final examination to be held on next month already. It's close to 1 month to uh, sit your final exam in strategic level. Right. Uh, I think you have already read the instruction and reading time 15 minutes and writing time 3 hours. At the beginning, very important thing where when we are going to practice for a mock exam and when we are going to sit for the final exam, very I will say the very important 15 minutes is the reading and planning time. It says the reading and planning. You have to plan your entire paper within this 15 minutes. It is very critical. You are not going to solve any issue. You first have to see what are the areas they have been tested. First, you have to read what is the requirement from the examiner. Then you have to prioritize. You have to plan how I'm going to answer each exam question. That is the very important thing you need to look at because otherwise it's very difficult if you are not if you're going to uh, right. Hope everyone can hear me, right?
Yes, sir, we can hear you.
Okay, Aruna. Then very important thing is the planning 15 minutes and then you have to start remaining 3 hours. Okay, in this paper we are going to discuss how it will be in the exam looks like and get familiar with the final examination. I will share the answer with you and then we will see how are we going to deal with similar incident in the examination. Therefore, very carefully you have to read the question and you have to very carefully you have to arrange them accordingly. Right. Now, first question, we will read section one. First question, we will read what they are asking. Right. Trio is a leader exporter in spices in Sri Lanka. Recently, the company did a feasibility study on adding a curry powder mix to its product portfolio. The estimated investment is 200 million. That is the initial investment in property, plant, and equipment. The estimate time period for the project is 5 years. 5 years given 200 million in the initial investment. Keep in mind that is the 200 million you are going to invest. The expected cash flows over 5 years given cash flows they have given 60, 65, 72, 75, and 78. The investment in working capital is estimated as rupees 10 million. This will be financed using the cash in the business. That means the working capital requirement is that generally when business start, you have to put working capital. At the inception, we will assume it is an outflow at the beginning and at the end, it will be realized. But here also it is mentioned that working capital can be realized at the end of the project period. At the end of the project period, it will be realized it is an inflow at the end. The expected realizable value at the end of the project period is rupees 20 million. Now, plant and machinery, there is a scrap value. You can realize. Then, when you are going to calculate the taxation, you have to look at what is the tax written down value. If you have already claimed capital allowances, then entire amount will be taxed at the end of final year, right? The current tax rate applicable to Trio is 14% per annum and capital allowances can be claimed 25% per annum on a straight line basis. That means 25% means this 200 million, 25% 50 million you can claim over first 4 years. Then total tax written down value at the fifth year will be zero. Then entire sale proceed this amount, what's that? Entire amount will be taxed because the tax written down value zero, sale proceed is 20 million, gain on disposal 20 million. Right, entire 20 million will be taxed at normal rate. Okay. Tax will be paid in the same year and tax losses incurred, if any, will be carried forward and written off against future profit from the investment. Therefore, taxes will be paid in the same year which it arises. It is clearly mentioned that otherwise we have to assume taxes will be paid in year 1 year in arrears. The risk-free rate of return per annum is 6% and beta factor of TRIO is 1.3. The expected market return is 12% per annum, right? Market return is 12%, then you have to look at what is the market risk premium. Based on that, you can easily calculate what is your cost of equity. That is capital asset pricing model you have to keep in mind. Can you remember how you have computed the capital asset pricing model? You can calculate capital asset pricing model. Do I need to write? I think you are very familiar with that. Cost of equity equal risk-free rate plus beta factor into no. Oh my God. Then without having knowledge about capital asset pricing model, CAPM, when you're going to, I will show you, give me a second. Because it's very pathetic if you don't know. Yeah, I will show you how to do the computation. Okay, I will say in capital asset pricing model cost of equity, you can calculate risk-free rate plus beta, okay, beta factor into market return, okay, market return minus risk-free rate, risk-free return. Simply is risk premium. Clear? Therefore, in this case, if you look at risk-free rate, RF equal to 6%. Market return that is MR equal to 12%. That means you expect additional risk premium because risk-free rate is 6%, market expect 12%. That means your risk premium equal, guys, please mute your mic. 12% minus 6%, simply it is 6%. Now beta factor, beta factor, it has mentioned what is the beta factor? 1.3 times 1.3. Then your cost of equity equal 6% risk-free rate plus 1.3 times it's a beta factor, risk premium, market return minus risk-free rate, that is 6%. And I will write down like this 12% minus 6%. Then your cost of equity equal 6% plus 1.3 into 6%, it is 7.8%. Simply it is 14.8%. If we round it off to the nearest 2 decimal, it should be 15%. That is your cost of equity will be 15%. That's how it will work. That's how it will computed. It will be computed. Because when you come to this level, you can't say, I don't know how to calculate cost of equity. Is it 13.8? Yes, 13.8. So 13.8. 13.8, that means 14%. Right? 13.8. Don't say that I don't know how to calculate capital asset pricing model, because you have to know that. Right? Because you are in strategic level. If you don't know when it comes up to this level, I can't believe. Anyway, I will move back to the paper and we will see what the requirement. Look at here. To finance 70% of this project, TRIO is planning to obtain subsidized loan facility from the Export Development Board for 5 years, which will be repayable in equal annual installment and at an interest rate of 12% per annum. That is the cost of debt. You have to pay at 12%. The current market borrowing rate is 18% per annum. That means you are getting benefit of 6%. Right, we will see. In addition, Trio is expected to offer a right issue to its shareholders to finance the balance part of the project. Now, assume 70% of the project financed by debt, then balance 30% is the equity, right? The issue cost will be 5% and it will be allowable as a deductible expense. Okay, we'll see. Required. Now you have to act as the Chief Financial Officer, CFO of Trio, advise the board of directors of the company on the investment decision using the adjusted present value method. Right, I can share the answer. I can share the answer screen, but first, since this is the first illustration, I think you have this information. Shall I move to the Excel sheet and I will show you how to do a proper computation? I think you agree with me, and we will do a proper computation using Excel. Okay, I will only for this illustration then remain, otherwise we don't have sufficient time. But I will go and explain one by one how to do a proper computation, how to compile this answer. Simply say, I have done similar kind of illustration even in corporate level. Right. Anyway, we will see how are we going to tackle this illustration. Okay, I'm moving to Excel sheet and we will tackle this illustration. Right. Question 1. Now project duration is 5 years. Therefore, years I will say here marks allocation right. Year 0, year 1, year 2, 5 years is the period. 5-year period. Now we will start with, I will take these sheets in rupees 1000. Rupees 1000. Like I mentioned, the figures are given in rupees 1000. Right, initial investment. We will take the initial investment. There's no issue. Initial investment. Initial investment. It is an outflow, 200 million. 200 million, it is an initial outflow. I will put it as 200 million in thousand. 200,000 in design rupees 1000. It is an outflow, right? Then this initial investment can be recovered at the end of 5th year, right? Okay, or even you can put in a separate line or you can put in initial investment here itself. There's no, it doesn't matter. Okay, I'll say scrap value of machinery. Scrap value of machine, it is an inflow, 20,000 you will get, that is 20 million you will collect at the end of the project. You can see. Then what's the next one? On the other hand, it says that cash flow is being given, cash flow before tax, right? Okay, we'll take cash flow before tax, given before tax. First year, 60 million, that is 60,000. Second year, 65,000. Third year, 72,000. Fourth year, 75,000. And finally, 78,000. Right. That is cash flow before tax. In addition, if you read the paper, you go back to the paper, it says that applicable tax rate is 14% and working capital 10 million. Working capital at the inception, you will put working capital 10 million, that is 10,000, and says that it will be recovered at the end of the 5th year. Right. Now, this is working capital. First, I will take this subtotal here. Net cash flow before tax. Cash flow before tax. Totals. Right. Then working capital. Then you have to calculate taxation. Taxation. I put a working. I'll put working number one. I will leave some space. Right. I will leave some space and calculate working number one. Taxation. Taxation. Now you have year 1 to year 5. Year 1 to year 5. Right. Year 1 to year 5. Now we will take cash flows before tax. Cash flows before tax, net cash flows before tax is available. Net cash flow before tax. I will take this one. Year 160,000. Likewise, it looks like this. Right. Now what they said that you can claim capital allowances 25% on a straight line basis. Now 200 million into 25% means you can claim 50 million a month. Therefore, less capital allowances. Capital allowances 50,000, or you can even say 200,000 into 25%. 50,000 you can claim as a capital allowance. Right. Within 4 years, you will claim in fully. Now in this 98 million include 20 million scrap value of machinery. Will it be taxable? Yes, because within the first 4 years, you have claimed the taxes in fully. Then this is the taxable profit. Now you can arrive taxable profit. Profit you can arrive 60,000 plus 50,000, that is 10,000. This is taxable profit. Now tax at 14%. Tax at 14%. Taxes will be paid in same year, and tax is liable tax you have to pay at 14%. So this one into 14%. Right. This is the tax amount. Now you can deduct taxation from year 1 onwards. This is the taxes will be paid in the same year which it arises. Right. Taxes will be paid in the year which it arises. You can deduct those taxation. Now you can calculate. You can calculate net cash flow after tax. Net cash flow after tax. Net cash flow after tax. This one, including this one. Right. Net cash flow after tax, that is done. Now you have to find out the cost of capital rate. How can you find out the cost of capital rate? It says that, what it says? It says that you have to borrow at 12%, right? Your tax rate is 14%, and cost of equity you have already found out it is 14%. Now you have to calculate what is the cost of capital rate. If I go back to the paper, the paper itself says to finance 70% of this project, we plan to obtain subsidized loan facility, 70% debt, 30% equity. Interest rate is 12%. You have to calculate cost of equity, already we have done. Cost of debt, pre-tax, it is 12%, right? We will go back and see how are we going to deal with cost of capital. Then cost of discount factor. Discount factor. Working number 2. Now you have to remember the things you have learned as cost of capital. How to calculate WACC. Working number 2. Discount factor. Cost of equity equal risk-free rate plus beta into risk premium. You have to calculate. Now you have already calculated it as 14%. Cost of capital 14%. What is the weight? Out of the project, 70% you will finance through investment. 70% from debt, cost of debt. Cost of debt equal interest rate into 1 minus T. Simply, if you calculate it, interest rate is 12%. 1 minus T is 14%. Right? Simply, the value should be into 1 minus 0.4. You can get cost of capital, cost of debt, 10%. Now you are going to invest 70% from debt, then 30% from equity. Clear? Then you can calculate WACC. It's very simple. 14% into 30% is 4.2. 10% into 70%, 7.224. If you calculate it, then you can cost of capital rate. Weighted average cost of capital rate is 11%. Right? Weighted average cost of capital is 11%. If you finance through 70% debt, 70% equity, right? If you 100% finance through equity, cost of capital rate is 14%. Right. Now you can say either equity, if you fully funded through equity, what is the value? If it is weighted average cost of capital, then you have to say what is the NPV of the project. We'll see what they are asking. They are saying that the paper the risk to finance 70% of this project, Trio is planning to obtain subsidized loan facility from the Export Development Board for 5 years, which will be repayable in equal annual installments at an interest rate of 12% per annum. Right. If it is 12% per annum, the current market borrowing rate is 18% per annum. In addition, Trio is expected to offer a right issue to its shareholders to finance the balance part of the project. The issue cost will be 5% and will be allowable as a deductible expense. Right. Now it is very much clear that now you are going to finance the project through debt and equity. Then we have calculate cost of capital WACC as 11%. Now your discount factor is 11%. At the beginning of the year, anyway, it is 1. Discount rate is 1. Then first year, 1 divided by 1 plus R. 1 divided by 1 plus R. 1 plus R is this one. Yes, we have considered the tax scrap value for the computation. See, the scrap value of machine 20,000. Here it is 78,000. Total 98,000 we have taken for the computation. Because tax written down value is 0. Entire sale proceed will be taxable. You can see 200 million is the investment. 200 million we have already claimed. In the 5th year, whatever the disposal is, disposal gain, it will be taxed at normal rate. Right. Then we will see discount factor. Right. These are the discount factor at 11%. Kill them. We'll put as 11%. We have mentioned in working number 2. Now you can calculate what is the net present value or discounted. You can take discounted cash flows. Discounted cash flows. Cash flow into discount factor. Right. Now you can take the values. NPV. NPV. I will call in base case. Base case because we have to adjust some issue cost relevant to the project finance we have not considered here, and the benefit you may receive from the repayment of loan we have not considered. We have to consider that one. It is called adjusted present value. They ask to calculate the adjusted present value. First we will calculate net present value. It is 44,356. 44,356. Right. Clear. This is the base case NPV. Now you have calculated. Yes, I have mentioned that this is the weighted average cost of capital. First, it's given that based on WACC, adjusted present value, if it is totally funded through the equity, then you have to take the equity value. Give me a second. What your question is? Question. Okay. This is sorry. This is not. Yes. Yes, someone. If there's some. Yes. Tell me. Any questions? Otherwise, please mute your mic. If it is 100% financed through the equity financing, right? If it is financed through the equity financing, then it will be different. Then you have to take 14% as discount factor. Now here they have specific. Guys, please mute your mic. I didn't get you. One student has mentioned we have to calculate equity in PV, but here they have specifically mentioned that you are going to finance the project 70% debt and 30% equity. Is agreed? Is it clear? The NPV at equity, if we lose the equity financing, your discount factor will be 14%. Right. This is WACC, based on WACC. Right. If it is equity financing, you can calculate. You can calculate. Now we will calculate discount factor, factor at 14%. That is equity. 100% equity. 100% equity. Then here it is anyway 1. Then 1 divided by 1. Then calculate discounted cash flow. 40%. In NPV. Scales. $27,620. 27,622. Right. Now you have to calculate adjusted present value. When you're going to calculate adjusted present value, you have to see what is the benefit you have received. Now, when you're going to finance through debt, right? If you're going to finance through debt, you will receive some benefit because your cost of debt is 12%, but in the market rate is 6%. Therefore, you have to calculate what is the benefit you have received. Instead of paying 18%, you are paying only 12%. Therefore, you have to calculate side effects of debt financing. Side effect of debt financing. What are side effect of debt financing? Concessionary loan, interest benefit on concessionary loan. Interest benefit on concession loan. Second one, you have a benefit over tax shield on interest. Tax shield on interest. Okay. First, I will calculate. You are going to finance 70% of the investment through debt. Investment. And 200 million, I will say 200,000 into rupees 1,000 into 70%. That means 140,000 you are going to finance through debt. This is debt. Now period is 5 years. Period 5 years. 5 years. Now you want to find out interest rate. Interest rate 12% per annum. Now what is the monthly installment? Or not monthly installment, annual installment. Installment value you have to find out. You have to find out the annuity factor for 5 years. You can easily in Excel, you can easily work out just exactly PMT. PMT payment. Rate is given, rate is 12%, comma, number of period 5 years, present value 140,000 each year. You are going each and you are going to pay. This is the amount you are going to pay. This is the installment value. This is the installment value. Then you can calculate amortization schedule and you can look at what is the interest amount and what is the benefit on interest you can calculate, right? Because it is you have the tax shield on that, then you have to calculate what is the tax shield on the interest portion. Okay, we'll take year 1, 2, 3, 5. I'll say opening balance OB, installment. We are preparing amortization schedule, interest at 12%. Interest at 12%. Interest at 12%. Then capital repayment. Capital repay and closing balance. Capital repayment and closing balance. Close. Opening balance, this amount 1.4 million, sorry, 140 million is 140,000. Installment value, it is fixed. Right, this amount. Interest you can calculate this amount into 12%. There is the interest amount. Capital repayment, out of this 38,000, you are paying capital interest of this much. This is the capital repayment. Then your closing balance will be 140 minus this amount, 117,000. This becomes the opening balance. Installment will remain same over 5 years. Interest you will charge on the outstanding. Then capital repayment you can easily work out. Drag and drop. Interest. Then it is 0. This is the interest you have paid. Interest amount at 12%. Then if you pay interest, you have a tax shield. You can easily calculate what is the tax shield and its present value. On the other hand, you have received a benefit. You are paying 12% only, which should have been 18%. That means 6% interest benefit you will receive. Then what is that benefit? You have to calculate interest benefit out of the that this is an interest you are going to pay. 16,800, 14,150, 14,000. These are the total interest you are going to pay. Then you will save a tax shield. Tax shield. What is the tax shield? You can use, I will show you the answer, then you it little bit we have to calculate further. Now you have tax shield will be there 14%. I will work out it here itself. Tax shield on tax saving. I will say tax saving on interest. Tax saving on interest. You have to pay 14% tax. You can save it. Some tax saving. You can save the tax in this amount, right? Then you have to calculate the present value of this tax payment. That is gain of 6%. You are claiming 6% gain, you will be there. You have to calculate that one. You have to calculate interest factor, and thereafter we can saving on interest. You have already calculated. Now you have discount this side. Discount factor at 12 minus 18 minus 12 at 6%. You have receivable benefit. You have to calculate discount factor equal 1 divided by 1.06. You can calculate the present value of the saving. Plus, you will receive another benefit. This is, I will take the cumulative discount factor. Another benefit for the 140,000 for 5 years. You are paying 140,000 into 6%. You are getting a benefit that you have to calculate how much is the benefit you will receive. I will show you the answer and things later because it will take much time. Okay, if you go through, this is the schedule which I have prepared. This is the interest portion and this tax benefit. Tax relief 6,607 in rupees million, rupees thousand. Benefit of low interest rate 140,000. Now we are paying 18 minus 12 6% into tax relief into 86% into cumulative discount factor for 5 years, right? If you work out this one, no, not the risk-free rate, not the risk-free rate loan. It's not the risk-free rate. 6% is the premium you will may have received over 5 years. Then value will be 30,427. Then total value will be 37,034. And base case NPV, as I have found, that is equity NPV, that is 27,543. The effect on subsidized loan 37,034. Now look at what is the issue cost. Issue cost will be, because we are not issuing 200 million, we are not raising through the equity. This 200 million we are issuing from debt 70%, equity 30%. Right. Based on that, you have to target 5%. Right. Then there is the issue cost net of tax will be 2,760. Okay. Then your adjusted present value will be 61,861. Right. That is how it will work. First, you have to calculate the NPV. That's the base case NPV based on equity factor. Then you can, this is ungeared beta or cost of equity we have calculated. Then you have to look at about the tax relief and all, then calculate what is the adjusted present value. It is a little bit extended version of computation, you have to do up to that extent in this illustration. Now here it has mentioned that the adjusted present value shows the positive present value with the side effect of debt financing. Therefore, if you go through equity finance only, your NPV will be a little lower because it is 14%. But if you take debt financing, it has a significant benefit over equity financing that you have to take in mind, because the equity capital they are charging at 12% after tax effect. Removal of the tax effect, it will be 10%. That we have to count. Because that is the first illustration, right? First illustration we have discussed. Organization pursue different objectives, profit maximization and wealth maximization. Differentiate the concepts of profit maximization and wealth maximization. How are we going to differentiate both concepts? Profit maximization, if you look at about the profit, we always trying to maximize the profit in short term. That is, most of the time it is short term oriented. In short term, we are going to increase the profits. But if you look at about the wealth maximization, you're going to maximize shareholders' value. That is a long-term objective. Wealth maximization is not a short-term one. It is a long-term objective. Then if you look at about the discretionary expenses, or if you look at about the expense types, more managers are more willing to invest in short-term investment, or they are not going to do some income gen or futuristic investment or income generated investment, because they are looking at immediate increase in profit, not the long-term investment, long-term value creation. They are not focusing. But shareholder wealth maximization, you will do the investment which will maximize the value. As an example, research and development expenditure, it will take some time, it will generate value over the period. When you incur R&D, your short-term profit will decline. Therefore, profit maximization, it will discourage. But shareholder value maximization, it will encourage. Right. Risk management, also always looking at to risk increase the profit while minimizing the cost. Right. Then, okay, we'll take the answer and quickly go through the answer. Then you can easily understand. Okay, this one. Timeline, short-term profit maximization, long-term increase shareholder value. Discretionary expense may opt to reduce discretionary expense in advertising, research and training, because the effect of those expenses will arise in future, not in immediate term. It will be long term. Pricing strategy, the pricing strategy, increase selling price to maximize profit in short term. You are not looking at the long term, but trying to maximize your short term profits. Therefore, increase the profit, you will trying to increase the selling price. You can take different example. We can take recently some manufacturers, they have suddenly increased the prices in order to maximize their profit while saying that inflation. But ultimately what have happened to them, their demand has fallen. It is not a sustainable pricing. But if you are going to create a shareholder wealth, pricing should be long-term sustainable pricing. The pricing strategy should be able to attract and maintain customers in long run. That is very important. Risk management, they are trying to cutting down expenses, but risk management aspect in value creation, shareholder value creation, would invest and spend on risk mitigation. Production capacity, optimum production capacity to maximize short-term profit, but wealth maximization, they are going to invest in increasing of production capacity in long-term value creation. Those are the difference, because always profit maximization, it is short-term oriented and short-term benefit targeted, but wealth maximization is long-term oriented, right? That's very much clear. Okay, that is part B of the illustration. Hope you have understood. Then part C. See, LPPLC just issued LKR 100 5-year bonds with a coupon interest rate of 12% per annum, redeemable at par, right? The current market price of a bond is 96. Calculate the required rate of return of the investor. That is simply, Lamai, it is yield to maturity. In this scenario, coupon rate 12%, if required rate of return is also 12%, market price should equal to 100. But if it is less than 100, mean the investor's required rate of return is greater than 12%. That's pretty much clear, because there are three types of bond we can value: premium bond, discount bond, and par valued bond. Now, if it is par valued, mean your coupon rate equal to required rate of return of the investor. But in this case, your market price of the bond is lower than the face value. That incident, we can say 96 mean cost of capital or required rate of return is greater than 12%. Okay, now you need to calculate, then you have to calculate yield to maturity in order to determine their required rate of return. At 12%, definitely it is 100 rupee. The bond contain income that is 12% on face value, that 100 into 12 rupee you will receive over 5 years. And at the end of the 5th year, you will receive 100 rupee. Then you have discount present value of future cash flows. Clear? Then I will show you how to calculate the value of the bond. I will show you the answer. Not to save the time. A second. I'll take this one. When you are going to calculate value of a bond, it should be equal present value of coupon interest plus present value of redemption price. Present value of redemption price. Now this particular bond face value is 100. Coupon interest 12%. Term to maturity 5 years. Now you have to find out the present value of future cash flow. Now the market price is of the bond 96. Okay, if you retain this investment, if your cost of capital is assumed 15%, what is the present value of future cash flows? Okay, I will calculate. If required rate of return equal to 15%, present value, you have to calculate the present value. Then you have to calculate annuity factor. Okay, coupon interest 12% interest you will receive 12 rupee per annum over 5 years. Then you have to calculate annuity factor. Therefore, value of bond 100 into 12, that is 12, right? 1 minus 1 minus 1 plus R 1.12 power minus 5, not 12. This should be 15%. Your cost of capital is 15% minus 5 divided by 0.15 to 12. Right. This is the present. You are saying 16%. We'll see. 40. This is the only for interest portion. This is only for interest portion. Plus 100 rupee into 1.15 power minus 5. 89.94. Simply I will say 90. Value of the bond at 15%. It is 90. Right. Then value of the bond, market price is 96. No, definitely it should be less than 15%. If required rate of return, equal to 12%, definitely value of the bond should be 100. It's a par value bond. But market price is 96. It is in between 15 and 12, not 16. Your answer is wrong. 16 is wrong. Then in between 15 and 12, it should be greater than 12, less than 15. Now we will calculate. Now you can use IRR formula to find out the answer. Now if you want to collect it on, if your required rate of return is 90, you have to forego 96. Right. Then here your opportunity cost is 96. If your required rate of return is 12%, you can collect 100, you have to forego 96 current market price. Then you can see the NPV. Here NPV is minus 6. Here NPV is plus 4. Then you can use the IRR formula to find out what is the required rate of return. IRR equal lowest discount factor plus NPV at lowest discount rate divided by NPV at lowest discount rate minus NPV at highest discount rate into highest discount rate minus lower discount rate. This is the complete calculation. If you compute this one, then you can easily calculate what is the IRR rate. I will work out the lowest discount rate is 12%. 12% plus. NPV at highest discount rate is, lower discount rate is 4. Divide by NPV at lowest discount rate 4 minus 6 into highest discount rate is 15% minus lower discount rate is 12%. Your rate is approximately 13.2. Investors require rate of return close to 13.2. Exact value I have taken. 13.2 is the expected value. Okay, that is how it will compute. Because the market price is 96 at the moment. If you expect 12%, the market price should be 1200. If it is you expect 15%, market value should be 90. But 96 is in between 90 and 100. The rate is 13.2. Okay, I will show you the answer. That's a quick answer I have just discussed. Yes. 99.96 mean it is 100. This is 76. If it is 20%, it is 76.08. Now you can see NPV computation, and it is 13.3, the rough approximation. Right, it's clear. Number 2 of the paper, what is the second question in the paper asks? Calculate the value of the bond if the investors required rate of return is 16%. Part 2. If their required rate of return is 16%, how are you going to calculate? Because these are the cash flows. These are the discount factor at 16%. You will receive 12 million each up to 5 years. Plus in the 5th year, you will receive 100 rupee face value. Then 100 rupee worth of investment or treasury bill or bond, treasury bond. If it gives 12% coupon rate, if your required rate of return is 16%, you are going to pay maximum of 86 rupees and 89 cents. That is the value of this investment. Value of this bond will be that amount. Hope that is clear. That is for the first illustration. That is for the first illustration. Shall we move to the second one? Second question. I will move to the paper. I will just guide you how to do the computation, and because you have already done the computation and you have done, now you can realize where it went wrong. Frontier Private Limited is considering investing 500 million in 2 securities out of 3 available investment opportunities. There are 3 opportunities. You are going to invest out of that 2. There are market conditions. There are boom, normal, and recession. Return from A, return from B, and return from C. You can see this one. If the company wishes to invest in security A and B, rupees 300 million will be allocated for security A. If you're going to invest A and B, you will allocate 300 to A, then balance 200 to B. If the company opts to invest in security B and C, or security A and C, answer for first part. First part still we have not discussed. Part question number 2, part A, and we are discussing. Still we have not discussed. Question number 1 we have already done. Right. Now, if company opts to invest in security B and C or security A and C, then money will be invested. Security C will be 200 million or 300 million in C1. YTM calculation, right? I will show you the answer. I thought you will all have done it. Okay, computation, I will show the answer. Here, this is YTM computation. How it has been computed. You have to calculate NPV and see what is the yield to maturity. Because at 12%, your present value of future cash flow is 100. Market price is 96. That means 4 rupee gain, right? If NPV at 20% is 76 per rupee, then your NPV will be 20 loss. Then definitely it should fall between 12 and 20. This is IRR formula you can use to calculate yield to maturity rate. You can screenshot or photo, you can take it. Then we will move to the next one. Next one, I'm moving to the paper. Right. Look at information of the return is given. Information and their respective probability. If the company wishes to invest A and B, it is 60% A, 40% B. That means 300 million A, 200 million B. If the company invests in B and C now, company will invest 200 million in C. If A and C, company will invest 300 million in C, then 200 million will be A. Okay. The covariance between the returns of the security is given below. If the covariance is high, mean their standard deviation will be higher. That means if the standard deviation are lesser, that is much better. Now, if you look at about the covariance A and B, there's a variance. B and C, there's a slightly compare higher variance, covariance A and C. They are lower covariance we can see in A and C. If you take the two data set, you can what x minus x bar. Then you will get x minus sigma into x minus x bar into y minus y bar divided by n minus 1. That is the way of calculating covariance. If the covariance is minimal, mean those data set or those investment are much closer in similar characteristic can be shown. If you look at about A and C, 20 here 22, 16, 12, 8, 6. But if you look at A and B, 20, 25, 16, 6, significant fluctuation, 8, area minus 5. Look at see A and B, there's a variance. If you look at about B and C, 25, 22, 6, 12, minus 5, positive 6. So another variance is 0.8, right? Advise the company on the optimal portfolio by analyzing each possible portfolio. There are three options: AB, AC, or BC. Those are the scenarios. Now calculate each investment option. What is the expected return? Now, boom, return of A, 20% into 20, 16% into 50%, 8% into 3%. If you calculate it simply, it is 4 and 8, 12, 12 and 14.4 is the return of A. Look at that. Return of B, 5 and 3, 8, 8 minus 1, 1.5. Likewise, you can calculate the expected return. Then look at about their variance. You have to calculate the variance of these investment and then see which one is the most suitable one. The standard deviation is less, that means there's no much fluctuation. Okay, right, we will move to the answer and I will show it to you how to deal with that. Okay, these are the expected return. 20 million to 20 is the profit, that is 20% probability. 16 into 50%, 8 into 30%. Expected return of A is 14.4. 14.4. 20% is the return in economic situation is condition is boom. Normal situation it is 16. Recession is 8%, the 30% probability will be there. Then your expected return of A is 14.4%. B, 25 into 20%, 6 into 50%, minus 5 into 30%, it is 6.5. Expected return of B is 6.5. C, 22% to 22 into 20%, 12 into 50%, and 6 into 3%. It should not be -1, right? Then the answer is 12.2% is expected value of C. Definitely by looking at the figures, definitely you will not recommend B and C or A and B, because expected return of A and C is much higher. Okay, now we will look at the standard deviation of each one, A, B, and C. The standard deviation, you can take 20%, that your average one is 14.4. Then 20 minus 14.4 square plus into 20% is the probability. Then 16% into 14.4 into square into probability is 0.5. Likewise, you have to calculate the variance into square root. Right, then you can get the standard deviation. These are the standard deviation. If you look at about this scenario A, B, and C, A and C, like A and C has the lowest standard deviation, and their expected return also higher. And if you invest in A and C, what should be the combination? A and C, 200 A, then 300 C. That is the way of investment. 200 A, 300 C. Now, if you calculate expected return while giving the weight, you will receive highest expected return in A and C. If you invest A and C, AB investment, you will get 11.24%. B and C, you will get 8.78. A and C, you will get 13.08. Right. That is the expected return. Again, you can calculate the standard deviation. The standard deviation, lowest standard deviation there at A and C. A and C. And then you can recommend, here it gives the highest expected return, and here it gives the lowest standard deviation. Then you can recommend Frontier company should invest 200 million in security A and 300 million in security C, as it gives a return of 13.08 and a standard deviation of 3.79. Right. That's there. Therefore, because when we are going to select an investment, you have to look at about their standard deviation, and then you have to look at about their expected return. A and C, look at standard deviation of each individual investment. Lowest one is A, highest one is B, middle one is C. Therefore, AC is more preferable when it comes to the volatility of the return. And if you calculate the expected return, there's no need to further analysis. Expected value calculation, highest expected value or expected return will given by A and C, investment in A and C. That is for the answer A. For the question answer for 2A, which is the answer. You have to invest in A and C. Okay, we'll go back to the paper. If you have to advise company should invest in A and C. Yeah, discuss effect of the types of risk. If you invest in a portfolio, you have to look at about the less volatility, because if they are in less volatility can be found in A and C, because their covariance also lower and they can expect higher expected return if they invested in A and C. That is the answer for part 2. B. This is relating to options and forward contracts. Okay, we will see how now sometime you might have to learn about call option and put option. You might have already learned. Now this one we will see is a payable amount of 500,000. You have to pay 500,000 in 31st December 2022. In a future date, agreed to pay. That is a call option, right? We'll see what kind of question they might ask. The company expect to dollar to appreciate further in future and considering hedging foreign exchange exposure using below techniques. There are two options given, right? First one, TRC can go for a forward contract at 3-month forward rate of 380. 380 is the forward rate. After 3 months, you will pay 380 and you are going to enter into an agreement. It is not breachable because you have agreed. It is a forward rate. You have to agree and finish. 380, you will pay 380 per dollar. Then total amount $500,000, right? Option 2, TRC interested in buying USD 50,000 options with the strike price of $1 equal 375. The cost of an option is 100. Now 50,000 option mean you have to buy 500,000 divided by 50. You have to buy 10 options. You have to pay 100 each, 100 into 10,000 rupee. Sorry, not rupee. You have to pay $1,000 to purchase this option. Option is you agree to buy or agree to sell in future date, but you have a right at the time of exercise date. You can decide whether execute or exercise the option or not. Required. On 1st October 20, TRC has decided to go ahead with the currency option instead of the forward contract in order to hedge the foreign exchange risk, because no need to pay 380. Now here you can make it to 375. A forward contract in order to hedge the foreign exchange risk, where the spot rate was at that time 360. At that time 360, but you are expecting it will go up by 3 months period to 3 into some extent. However, the spot rate in 31st December 2020 is $1 equal to 370. TRC does not wish to exercise the currency option. Assess the decision taken by TRC. Now, if they have exercised this option, they have to pay $375 each. Now, if they exercise this option, they will lose 5 rupees, because at the market, you can pay at 370. Due to rejection or not exercising the option, each dollar you can save 5 rupees. Then 5 rupees into, right? You are saving 5 rupees in each. Now, then what is the total gain you are receiving? Is it 360? Yes. TRC is interested in buying 50,000 option with a strike price of $1 equal to 375. The cost of an option is 100. In the 1st October, TRC has decided to go ahead with the currency option instead of forward contract in order to hedge the foreign exchange, where the spot rate was at that time 360. However, if the spot rate of 31st December 370, the TRC does not wish to exercise this currency option because it is not advisable to exercise this currency option. Right. Now we will look at total amount. If you have exercised this option, you have to pay 375 into 500,000. Look at what is the value, 375 into 500,000. You have to pay 187,500, right? If you have not paid this option, not exercise this option, how much you have to pay? It should be 370 into 500,000. 370 into 500,000. Then it is 185 million. 185 million. If you have not exercised this option, you will save how much? 2.5 million you will save. Right. On the other hand, that is not the total amount. And you have bought options 100 rupee each into 10, that is 1000 rupees, then 1000 into, at that time 360 is the value. You have paid 360,000 as option purchase cost. Okay, the net amount you have to calculate. Okay, I will show you the net computation, how we can do it. If we are not going to exercise the option. Hope you can see. Okay, the spot price 370. Exercise price. Exercise price 375. This is exercise price for option. Option. Forward contract price. Forward contract 380. Okay, first, if you now this is at the time of execution at 31st December 2022, the spot rate. Therefore, now if you exercise this option, you have to pay 375. Now dollar amount 500,000. 500,000. In rupee value, if you calculate the rupee value, 185 million. If option not exercise, definitely you will not exercise. Exercised. Cost of the settlement. Cost of the settlement will be 185 million, 370. Options exercise cost. $175,000. Now you can take the net saving, sorry, gross saving. $2.5. Then less option transaction cost. Cost of purchase and option. You have 500,000 each, 50,000 option. Then 10 option you have purchased into $100 at the rate of 360. Then 10 into 100 into 360. to 360. Into 360. Then you have to pay 360,000. Net one. They ask him what is the net benefit, because we can't ignore it because you have already paid. The net benefit is 2,140,000. The net due to your decision, what is the impact? Impact is 2,140,000 to decide to purchase the option. But anyway, 360 you have to purchase. If you go for the forward contract, right, due to not purchasing, not going to forward contract, what is the benefit? Forward contract, you have to pay 190. Value to be paid under forward contract. 190 million if you have entered, but due to option not exercised, then you have to pay only 185 million. Right, 185 million. You have saved 5 million. 190 plus 185. 5 million. Right. Then your option transaction cost also to be considered, even though you have not exercised, you have to pay the transaction cost. Right. Since you decided to go ahead with option, you have not entered into the forward contract. Due to that decision, you have saved 4.64 million. Right. Not exercise the cost of option 360. Therefore, what you have to say, you should not exercise the option and you should not go ahead with the forward contract. Since you have not gone with the forward contract, you have saved 4,640,000 because you have purchased an option, you have not executed it. That is the net benefit. Okay, I will share you the answer. To be paid if forward contract issues 190 million. Options premium 360. Option is not exercised. If you option exercise 187.5, as I mentioned, option is not exercised, you have to pay 185. Net amount not exercised plus transaction cost. This is the amount they have mentioned about, not the forward contract. Option value, it is 2,140,000. Right, that is not a big deal. When you are going to decide whether you are going to exercise this option or not, what you need to see, what is the exercise price and the market price at or spot rate at that time. Now we are moving to question number 3. Question number 3, CAPL. In the pre-seen information, those information you've been provided already. Right. We will read the illustration. It is similar to the project appraisal question what we have done earlier. We will read the illustration. First, CAPL had their recent board meeting and it was decided to grow the company via an acquisition as internal expansion will be slower. One of the reasons for this is to get economies of scale and expertise of SPA Lanka PLC on some of the products. They identified SPA Lanka PLC as the target company in the same line of business. This has a strong and well-established client base at SPA Lanka PLC. Profit before tax ended March 2022, 540 million, which is expected to grow by 4% per annum. Next 5 years, it will grow by 4%. Year 1 to year 5, it will grow by 4%. Depreciation and amortization expenses 60 million in 2022 will grow by 2% per annum for the next 5 years. Right. Cost of sales is 1.5 billion and expected to grow the same rate of profit. The incremental working capital requirement can be estimated as 25% of the cost of sales. Profit grow when a rate taken, it has gone right, it's 4%, right? Okay. Capital expenditure will be 50 million per annum from 2023 and will grow 2% per annum for next 4 years. Okay, next 4 years it will grow up by 4% over the period, right? Tax. Effective tax rate is 15% on profit before tax. Assume that free cash flow will grow at 3% per annum for year 5 onward. That means you have to calculate terminal value. Discount rate should be calculated to 2 decimal point. Post-tax cost of debt can be estimated to 10%. Okay. Now, recommend a valuation for SPA Lanka PLC. You have to do the valuation. First, I will show you how to get the calculation, how to get the cash flows, and year 0 to year 5, we will see how are we going to deal with that, because we need to work out we need to calculate free cash flow. We need to calculate free cash flow. Okay, I am moving to computation. I will quickly show it. We will do this one. Okay. Here 0, here 1, here 2, up to year 5. Year 5. Okay, now we will see profit before tax given. Profit before tax. This is in rupees 1,000. Profit before tax. It says it will grow by 5. It is 540 million. It will grow by 4% per annum each year. That means simply at the beginning of the year 540,000. Right. 540,000 is the profit before tax. It will grow by 4% each year, 1.04. Now we will, it will 1 to 50, it will grow up by 4%. Right. Then they mentioned that depreciation and amortization 60 million. Then when you're going to calculate the cash flow, you have to remove the depreciation. Right. I will remove the depreciation. Depreciation less depreciation. It says 60 million at the beginning. 60 million. And it will grow up by 2%. Then this will be multiplied by 1. I have to deduct it because we have to, because profit before depreciate before tax, then you have to remove the depreciation. I'll assume that is the cash flow item. Cash profit. I will take the cash profit then. Better if we take the cash profit. There's no other adjustment. Cash profit. Cash profit. Then working capital requirement, they have mentioned what is the working capital requirement. At the initial cost of sales is 1.5 billion and to grow at the same rate as profit. The incremental working capital is requirement can be estimated 25% of cost of sales. Right, we will estimate working capital. Working capital. I'll put a separate working. We'll put a separate working. Working one about working capital. Working capital. Working capital. Okay. So we have to add. I made a mistake right here. Let's not. It has been already deducted. It should be added. Add, not minus. We have to add back. Because I'm totally went wrong. It should be added. Depreciation is cash, not a cash item. It should be added. Working capital. Working capital, it says that cost of sales 1.5 billion. Cost of sales 1.5 billion. That is 1.5 million in rupees thousand. Right. It will increase by same as net profit growth, profit before tax, 4% growth into 1.04. This is the growth. Working capital, 25% from cost of sales. This one into 25%, 390. This is the working capital balance. Therefore, incremental working capital, the incremental working capital. Here, anyway, incremental working capital 0 minus 390. Then 405, 15,600. Then 421 minus. This working capital we have calculated. Now you can working capital you have to add each year. These are the working capital requirements. First 5 years you have to incur these working capital total. It will run 423,797. In the 6th year, you will be able to recover it, right? You will be able to recover it. Okay. Now, what are the other adjustments? Working capital requirement we have adjusted. Then there's another adjustment. You are making capex payment. Capex. What it says, capex. Capex will be 50 million. And grow by 2% per annum next 4 years. Right, 50 million capex expenses will be there. 50 million, it will increase by next 4 years. In year 1, and it will increase by 2%. Year 1, it will be 50,000. Next 4 years, it will grow up by next 4 years in 2% each. Right. Now taxation, 15% on profit before tax. Profit before tax is there. You have to pay tax on 15%. Taxation. at 15% on profit before tax. Right. It is mentioned that on profit before tax only effective tax rate is 15 here. Right. Now you have to calculate what is the net cash flow after these adjustments. Net cash flow. Net cash flow. 98,560 to this one. Then when you're going to calculate next one, now you have to calculate the present. Now you have calculate the present value. Now discount factor you have to find it out. Is it given? It is not given. Cost of equity you have to calculate. Cost of debt is 10%. But you have to calculate the terminal value after the 5th year. End of the 5th year, the cash flows will grown up by 3%. Expected growth rate of the cash flow. This we'll see. Go back to the illustration and we'll see what it asked to do. Paper. Assume that free cash flow will grow up by 3% after 5th year. I'll go back. Fifth year onwards, the cash flow will grow up by 3%. You have to find out terminal value here. In order to determine the terminal value, you have to find out cost of equity or you have to calculate cost of capital. Now, up to this point, you have done with that, right? Thereafter, how are you going to deal with the cash flows? We have to see. Show you the answer. Right, we will determine cost of equity and cost of debt. Cost of debt already given. Okay. Now we have to see the cost of capital. We have to find out cost of a target company. Beta factor is given. I will show it to you. Okay. Target company levered beta is 1. Debt to equity ratio is 14 to 86. 14% to 86. 14 to 86. Now you have to find out ungeared beta. If you calculate the ungeared beta by using this one, x into x in xd into 1 minus t divided by e, that means 1 plus unlevered beta into, this is 14% is the debt into 1 minus T is the tax effect divided by equity 86. Then you will receive the answer 1.138. The unlevered beta will be 0.878. You will convert levered beta into unlevered beta. Then based on unlevered beta, now your company debt is 536 million. Equity 2242. Effective tax rate is 14.85. It is given in the illustration. Now levered beta is point, you have to calculate this is ungeared beta plus 8.78 into 0.536 into this computation that you are going to convert into levered beta. Your cost of equity will fall into 16%. Right? Cost of equity will be fall into 16%. Then weighted average cost of capital, cost of debt is 10%. Then you can easily calculate 16% into 2242 divided by the total cost of debt and cost of equity plus 10% into cost of debt divided by cost of capital. Answer will be 14.93. 14.93 is the cost of capital, weighted average cost of capital. That means we will round it off to 15%. Right. If we convert it to 15%, your cost of capital is 15%. Now we will see the computation. Now you have to calculate the terminal value. Now your cash flow 553,019 you have already calculated. Then end of year 6 cash flow, you can see this one plus 3-year growth. Then you can calculate free cash flow into KE minus G, or cost of capital minus growth rate. Then terminal value at this point will be 4.79, 4.746 million. How I have obtained that one? Your cash flow in the 5th year multiplied by 1.03, that free cash flow into 1 plus G, right? If you can calculate a dividend growth model, if you want to calculate the value, free cash flow into 1 plus G divided by cost of capital minus growth rate. Then you can easily work out this answer. Then 569, this one divided by cost of capital 15% minus 3%. The value is this one. Now you can take the total value, the present value of this one. Then total NPV, your cost of capital is 15%, total value is NPV is 3.7 billion. This is the answer. 3,732 is the answer. Right. Then that is the evaluation. First, what do you have to do? First, you have to see what the composition of debt to equity ratio. Now, this is a private limited company. When you're going to convert, you find the equity beta. Then you have to see a similar company. Then based, but their gearing may be different. But you have to ungeared, and ungeared beta should be regeared based on your debt to equity ratio in the company. Accordingly, then you can calculate levered beta. Based on levered beta, you can calculate the cost of equity. Then we have evaluated the option and the value is 3.7 billion. The answer I will share it with you. The computation 3.732. This one to be changed, it has to be changed. Up to this point is correct. Then other valuation methods, you have to recommend what are the other valuation method available. Now this is free cash flow based valuation. Remember, it is kind of an earning based valuation. But asset based valuation means we are looking at the fair value of net asset. But remember, when we are looking about the asset based valuation, it should be it will be looking at the historical performance. It is not looking at the whether it can generate some what is the earning potentials of this particular business. It won't be considered, right? When we are looking at the asset based valuation, you will consider the net asset basis valuation, and it does not reflect earning potentials of the company, right? It may not reflect what are the unrecognized assets in the balance sheet, may not reflect it. It is not a clear reflection of your earning potentials, skills of the workforce, and it will not be considered intangible asset. Might cannot be it might be ignored. Lawyer royalty and your goodwill, those won't be recognized. Sometimes you may not be assessed. The skill levels of the employees, it is a kind of an asset to the company, but those may not be recorded in the net asset value. Book value reflect, remember, book value reflect the old or historical value. If you deduct the creditor's value, the mini value will be sometime lower, but the real value of the business not like that. If you have the brand names, it has some value. Some entities, they have their real asset, biggest asset is the brand name. Therefore, that has a problem. Then market value, if the company is establishing Colombo Stock Exchange or the securities shares are trading in market, then you can easily calculate the value. If it is not there, the similar entity can be taken and then you can estimate the cash flow like this. Then based on that, you can evaluate the investment market value. Yeah, since the both companies are listed, there is an established market value for the companies. It represents the present value as a proposed prospect of company based on investor perception. Nowadays, if you look at the shareholder in a Colombo Stock Exchange, sometimes the value reflect in stock exchange, sometimes it might be manipulated, or sometimes it might be not. It might reflect the economic condition, right? Market condition, right? Next one, part C. Advice on what should they do post acquisition to make acquisition successful. Once you have acquired a company, therefore cultural clashes will be there because SPL Lanka and CAPL, they are two different companies. Therefore, when you have acquired them, the effect will be different, and that means there are so many clashes because they don't agree with the present condition. Sometimes they might argue, some employee might be leave the company, then it will be a utter disaster, right? If it is not done properly, if they have not placed their employees properly, then it will be a big disaster. That is the main concern, because cultural clashes, sometimes clients may not be come with the new acquisition, two different mode of management styles, they will be most critical when we are acquiring another company. Next one is the funding method. It's very common. There are two sources of funding, equity and debt. Since at the company level, debt to equity ratio is around 19 to 81%. Then if they come up with the same, or if they are going to uh, uh, debt financing, then they can reduce the increase the gearing because they are low geared at the moment. But on the other hand, if it is a risky one, then you can go for the equity funding. In this arrangement, they have maintained the same level of debt and equity, same gearing ratio. Then it will if they are going for same ratio they are going to maintain. They are not, their liquidity or their risk will be minimized. Debt funding, it will be not much, it will be risky, but their return will be much higher because theoretically cost of equity is very high. If they fund this entire amount through the debt, the gearing ratio would be 41%, right? Then still they are low geared. It's fairly better because the company is in a better position. Either you can select mixed financing arrangement, debt and equity, both composition, much larger proportion of debt or lower proportion of equity, you can do that one. Then part E of the illustration. We'll go back to the part E, what they asked to do. Part E of the illustration, they have given some information. TFL wishes to purchase special type of Ayurvedic medicine from Kelsey PLC and need to have understanding on profitability of the potential supplier before start transaction. Kelsey PLC gross revenue of the year ending 31st March is 50 million with the gross profit margin of 25%, administrative expenses 10% of revenue, excluding depreciation. Depreciation was around 5 million. They have been able to moderate the bad debt to 2% of the revenue. Okay. The company spends 8% on revenue on advertising and sales promotion. In addition to the royalty payment, 1% of the revenue to the parent company. The company has 2 months inventory, 1 month debtors, and 2 months credit from its suppliers. The entire working capital is funded to short-term borrowings at 20% per annum. Company pays corporate tax at 14%. Assume there's no difference in accounting and tax profits. Prepare the income statement of Kelsey PLC for the financial year ended 31st March. Okay. Now we need to prepare the financial position. Okay. 50 million is the revenue. Done. Cost of sales, if they have mentioned that cost of sales will be 25%, sorry, GP margin 25%, and 75% is the cost of sales, 37,500. Administration cost 10% of the revenue, 5,000. Bad debt 2% of the revenue, 1,000. Selling expenses 8% of the revenue, 4,000. Royalty 1% of the revenue. Then earning before interest, tax, depreciation and amortization, 2,000. Depreciation 5 million, it mentioned. Earning before interest. Interest 833. How do you calculate the interest? Here it says that trade receivables 2 months. 2 months sales. You see, the company 2 months inventory, 1 month debtors. That is working capital you have to calculate. 1 month debtors means this 50 million. This is for 12 months. 50 divided by 12. 50 million divided by 12. It is how much? 4,166. Debtors will be 1 month sales. 50,000. 4,167. The debtors cost, right? 1 month debtors 4,167. 2 months inventory, cost of sales. This is 37,500. This is for 12. If it is for 2 months, then 6,250. Inventory 6,250. 2 months credit, 37,500 into 2 divided by 12. That means 1/6. Simply this is working capital cycle. This is working capital cycle. This is working capital amount requirement. Then 4,167 is the net working capital requirement. Then they have financed this net working capital financed by 20% working capital loan or bank loan. Then you will receive finance cost of 833. Once you deducted it, then profit before tax 1,162. Deduct 14% tax. Then profit after tax 999. Right, that's how that working capital calculation is not big issue. Here, cost of sales divide by 12 multiplied by 2, that is 2 months inventory value. Creditors also cost of sales divide, that is for 12 months. You are giving 2 months credit period, then it should be multiplied by 2. That's very simple. Then now your working capital requirement, you can see. Next question, what is the next question? Explain importance of reducing length of working capital cycle to any business. You are expected to discuss pros and cons of it. Now working capital cycle, here you can see inventory 2-month period, debtor 1 month, 2-month credit. Net working capital period, cash operating cycle is 1 month. Cash operating cycle is 1 month. 2 plus 1 minus 3. Sorry, 2 plus 1, that is 3 minus 2, that is 1 month working capital cycle. If it is shortened, the benefit is you can finance your inventory or debtors through trade payables. Then your finance cost will be reduced. But on the other hand, what will happen? If you're not paying your suppliers promptly, they will angry, then you will interrupt it with suppliers. The suppliers will reluctant to supply the goods. If you have a longer cash operating cycle, you have to borrow more fund. That means your working capital requirement will be much higher. If it is much higher, you will have to incur more finance cost. As an example, if the 2 months debtor period is 2 months, then this 4,167 working capital requirement will go up to 8,334. It will be double. Therefore, extended period working capital requirement will go up, then your finance cost on working capital will increase. That is the main issue. Here it says reducing inventory levels. Then if you reduce the inventory level, what will happen? Disruption can be happen if you not maintain sufficient stock in the in hand. If there's an emergency arise, you may not be able to cope up with it. Reducing receivables, in order to reduce the receivables, you might offer early settlement discount. Then customers, there's a high risk that customer will move from your company to another company, right? Because most of the customers are prefer a longer credit period. If you are reducing the credit period, they will definitely go out from the business. That can happen. Therefore, reducing of working capital, definitely it will reduce your risk in some extent in the liquidity, but from the sustainable perspective, sometimes there might be some significant impact. If you are giving a longer cash operating cycle, there's a risk of bad debts and you are losing through the higher finance cost. That can be seen. Increasing payables, the third option. If you delay the payable, then you are this kind of an unethical, because unethical behavior, because you are financing to pay creditors, because they also pay some liquidity issues. Therefore, the relationship with our supplier can be affected badly. Those are the major issues when we are dealing with, when we are going to reducing the cash operating cycle, right? Okay, I have little bit uh, uh, faster when explaining, because within a shorter period of time we need to explain. I have just summarized what kind of question that can be tested in this similar content. Then in the examination paper, similar kind of paper, structured paper can be seen. Under such situation, how are you going to face that one? How are you going to tackle that situation? The most important thing, you have to read the question first and decide the priority. And before going to the examination, you have to properly read the pre-scene and look at about the financial information may be provided, and you have to work out what is their debt to equity ratio, what is the gearing situation, if high geared or low geared, so what is the suitable financing strategy. If the company is high geared, then debt financing may not be suitable, right? Therefore, you have to properly analyze the pre-scene and summarize it. Some information, most of the information may contain in the pre-scene when you're going to face the examination. Right, that is the end of the discussion of mock exam paper. I have gone through a little bit, I have explained a little bit faster, but I think you have already gone through, you have familiar with the computation and all. Therefore, there is no issue with that. Right. Any questions? How can we get the answers? Aruna will share the answer script. He will share the answer script. No issue. You can go through the answer script and you can see what is the correct answer. He will share the answer script with you. Uh, Aruna, shall we conclude the session then? There's no questions and you can share the answer script.
Yes, okay, we can get answers.
Okay,
Publish
okay, okay, then we will conclude the session. Thank you everyone for joining, and I'll wish you all the best when you are going to sit the final examination. And don't get panicked. Read carefully and look at what is the requirement. 15 minutes, that is very important. Go through it, and then it will helpful for you to prepare for the final exam and do mock exam papers, do past papers, and prepare very well and identify, understand the structure of the paper. Then you can easily pass this exam. All the best for your examination, and hopefully you will be able to complete this time and you can go up to the next level, final level. Whether it's a case study level, you can go, you can process. Okay, thank you everyone for joining. Have a nice day. Nice to have a discussion with you all. Thank you for joining. Thank you, everyone.